My greetings to everyone. I am Professor Namita Rajput, Professor in Department of Commerce, Sri Aurobindo College, University of Delhi. In the ongoing series of corporate governance, today we are going to talk on institutional investors, their influence and impact. The institutional investors are the organizations that invest a large sum of money in securities, real estate and other investment assets. They play a very crucial role in the financial markets due to the significant volume of assets they manage and their impact on market liquidity and the pricing. Now, these investors include entities like pension funds, insurance companies, mutual funds, endowments and the sovereign wealth funds. So, let us see the introduction part of what the institutional investors are all about, their definitional aspect and their types. So, let us first talk about the definition. The institutional investors, the organizations or entities that pool a large sum of money and invest in the securities, the real estate and other investment vehicles. They are typically the large scale and sophisticated investors having the substantial financial resources and expertise. They invest on behalf of their members, policyholders or beneficiaries aiming to achieve the long-term financial goals. Now, what are the different types of institutional investors? Let's dwell into this important area. First, we will be talking about the pension funds. Now, these funds collect and invest the contributions from the employers and the employees to provide the retirement benefits. Managed by professional fund managers, the pension fund seek a long-term stable returns to ensure the future payouts. Let's take an example, the California Public Employee Retirement Systems and the Canada Pension Plan Investment Board, that is CPPIB. Now, the next is your insurance companies. The insurance companies invest the premium collected from the policyholders to pay the future claims and the benefits. They manage a diverse portfolio of the assets to balance the risk and return, ensuring that they can meet their liabilities. For example, it includes the companies like MetLife, Prudential and Alliance. Now, what is the future mutual funds? Now, the investment vehicles that pool the money from many investors to purchase a diversified portfolio of securities. Managed by professional fund managers, the mutual funds offer the investors access to a variety of asset classes and the investment strategies. Let's take an example, the Vanguard, Fidelity Investments and BlackRock. The next we talk about is the endowments, the funds established by the institutions like universities, hospitals and non-profit organizations to support their long-term financial needs. Managed to achieve a balance between generating income and preserving the capital for the future use. For example, Harvard University Endowment and the Bill and Melinda Gates Foundation. The next is your sovereign wealth funds, the state-owned investment funds or the entities that manage the national savings for the purpose of investments. Funded by the revenue from the natural resources, the trade surplus or the foreign exchange reserves, invest globally in the various asset classes. For example, include the Norway Government Pension Fund Global and Abu Dhabi Investment Authority. Next is your hedge funds. What are hedge funds? They are the pooled investment funds that employ the various strategies to earn the active returns for their investors. Now, often engage in more aggressive strategies, including the leverage, short selling and the derivatives. For example, it includes the Bridgewater Associates and the Renaissance Technologies. Next is your private equity funds, investment funds that acquire the private companies or take the public companies private, often the reconstruction to improve their value. They focus on the long-term capital appreciation through a direct investment in the business. For example, the Carlick Group and KKR. What is the important aspects and the key issues? The institutional investors are the pivotal players in the financial markets, providing the stability, liquidity and efficiency. Their large-scale investments and professional management, it contributes to the overall functioning and the development of the global financial system. Now, understanding the different types of institutional investors and their roles, it can provide a valuable insight into how the capital is allocated and managed in the economy. The institutional investors are the fundamental to the functioning and the stability of financial markets. Their influence extends across the various aspects of the market dynamics, including the liquidity provision, price discovery, corporate governance and market stability. So, let us see what their roles are. The first is your liquidity provision. Yes, we are now talking about what is the role of institutional investors in the financial markets. Out of this, first we will be discussing the liquidity provision. Now, high volume trading. The institutional investors, they typically engage in large scale trading activities, and by buying and selling significant volumes of securities, they provide the essential liquidity to the financial markets. The next is your market efficiency. Increased liquidity. It reduces the transaction cost and bid-ask spreads, making the markets more efficient and accessible for all participants. The next is your price discovery, which is supposed to be a very important role which the institutional investors in the financial markets have to play. That is informed trading. Institutional investors, they often have the access to superior research and market analysis, and their trade reflect informed views about the intrinsic value of assets, contributing to accurate price formation. The next is your market signals. The investment decisions of institutional investors, they can play a signal market trends and valuations to the other market participants, aiding in the efficient allocation of resources. The next is your corporate governance, that is active ownership. Many institutional investors, particularly the pension funds and the mutual funds, they actively engaged with the companies, they invest into the influence market management practices and the policies. The next is your proxy voting. Through their substantial shareholding, the institutional investors can exercise a significant influence over the corporate decisions via proxy voting at the shareholder meetings. The next is your long-term focus. Institutional investors, they often advocate for long-term strategic planning and sustainable practices, promoting the responsible corporate governance. The next is your market stability, that is diversification. Institutional investors typically have the diversified portfolio which can help stabilize the market by mitigating the systematic risk and reducing the impact of localized market shocks. The next important role as far as the institutional investors in the financial markets are concerned is the counter-cyclical investments. During the period of market stress, institutional investors, they may provide stability by engaging in counter-cyclical investment strategies such as buying undervalued assets. The next is your capital allocation, that is the resource allocation. By directing the capital to productive investments, institutional investors play a very critical role in the efficient allocation of resources in the economy. Support for innovation. Through venture capital and the private equity investments, institutional investors, they support the growth of new and innovative companies, fostering the economic development and the technological advancements. The next important role of the institutional investors in the financial market is the financial product development, that is innovation. The institutional investors demand sophisticated financial products and the services, driving the innovation in the financial markets. This includes the development of the new asset classes, investment vehicles, and the risk management tools. The next we talk about is the market depth. Their demand for the various financial products, it enhances the market depth, offering more opportunities for diversification and risk management to all the investors. The next is your risk management, professional management. Institutional investors, they employ professional fund managers who use advanced risk management techniques to protect and grow their assets. The next is your systematic risk reduction. By diversifying their investments across the various asset classes and the geographies, institutional investors, they help reduce the concentration of the risk in the specific markets or the sectors. The next is your economic stability and the growth, that is long-term investments. Institutional investors, they provide long-term funding to the business and the government, supporting the infrastructure projects, economic development, and the social initiatives. The next is your counterbalancing retail investors. They help balance the often more volatile investment behavior of the retail investors, contributing to the market stability and the confidence. The institutional investors are vital to the health and the efficiency of the financial markets. Their role in liquidity provision, price discovery, corporate governance, and the market stability, they underscore their importance in fostering a stable and dynamic financial ecosystems. By leveraging their resources and the expertise, the institutional investors not only seek the returns but also contribute significantly to the broader economic and the financial landscape. The institutional investors such as the pension funds, insurance companies, endowments, and the sovereign wealth funds, they employ a variety of investment strategies to manage their portfolios and achieve their financial objectives. Now, these strategies are designed to balance the risk and return, meet the specific financial goals, and adhere to the regulatory and the fiduciary responsibilities. So, here are some of the common investment strategies used by the institutional investors. So, let us have a look on this. The first we talk about is the asset allocation. The asset allocation is a process of dividing investments among the different asset categories like stocks, bonds, real estate, and the cash. The goal is to optimize the risk-reward balance and according to the institutional investment objectives and the time horizons. The next is your diversification. Diversification involves spreading the investments across the various assets to reduce the risk, and by investing in a mix of asset classes, industries, and the geographical regions, the institutions can mitigate the impact of poor performance in any single investment. The next is your active versus passive management. Now, what is an active management? The fund managers, they actively make investment decisions and trades to outperform the market. Now, this strategy relies on the research, market forecasting, and the judgment. Now, what is a passive management? Now, we talk about the investment strategies, and one of the prime strategies is your passive management. Investments are made to replicate the performance of a specific index, for example, S&P 500. Now, this strategy typically involves a lower fees and is based on the belief that the markets are efficient and it is difficult to consistently outperform them. The next investment strategy of the institutional investors is your tactical asset allocation. The tactical asset allocation, it allows for a more flexible approach to the asset allocation, and the managers, they adjust the asset mix in the short term based on the market conditions and the economic forecast, aiming to take advantage of the perceived market inefficiencies. The next is your risk management. Institutional investors, they employ various risk management strategies to protect their portfolios from a significant losses. Now, this includes using a hedging technique like the option and the future, as well as establishing a stop loss orders and setting the exposure limits. The next is your alternative investments. Many institutional investors, they allocate a portion of their portfolios to the alternative investments such as equity, hedge funds, real estate, commodities and infrastructure. Now, these assets can bring a diversification benefits and the potential for higher returns, albeit with the higher risk and the lower liquidity. Now, the next we talk about, as far as the investment strategies of the institutional investors are concerned, is the environmental, social and the governance, ESG investing. The ESG investing integrates the environmental, social and the governance criteria into the investment decisions. The institutions, they consider the factors like sustainability, social impact and the corporate governance practices, aiming to generate a long-term sustainable returns while contributing positively to the society. The next is your factor investing. The factors investing involves targeting specific drivers of the returns and across the asset classes. The common factors include value, size, momentum, quality and volatility. By understanding and leveraging these factors, the institutional investors, they aim to achieve a better risk return adjustments. The next is your liability driven investment, and we call it as LDI, primarily used by the pension funds and the insurance companies. The liability driven investment strategies, they focus on aligning the investment portfolios with the institutional future liabilities. This often involves investing in long-term bonds and other fixed income securities to match the timings and the amount of expected payouts. The next is your global investment strategies. To capture the opportunities worldwide, the institutional investor strategies diversifying their portfolio across the different regions and the markets. This can really help in mitigating the local economic and political risk and assessing the growth opportunities in the emerging markets. The next is your quantitative investing. Quantitative investing uses mathematical models and algorithms to identify the investment opportunities, and this data-driven approach can really involve a high-frequency trading, statistical arbitrage and other techniques that leverage the large databases and computational power. The next is your private market investments. Investing in private market includes the direct investments in the private companies, venture capital and the private equity. Now, these investments are typically long term and illiquid but can offer the higher returns compared to the public markets. So, we can say that institutional investors, they often combine the several of these strategies to create a diversified, resilient portfolio that meets their specific goals and constraints. The choice of the strategies depends on the institutional risk tolerance, time horizon, regulatory environment, and overall investment philosophy. So, institutional investors actually play a very critical role in this regard. Thank you so much.